Dear students, welcome to EPG Pathshala, and I am Dr. M.V. Shubha, and I am present to give a lecture on Fundamentals of Financial Management. Definition for finance. As we all know, finance is a very important resource and commonly understood as money. What is the use of money? Money has got multiple uses and it is a required resource by all people. So this particular money is important because money can be put to multiple uses. Money is capable of buying different commodities and different luxuries in life. And in business parlance, you will find that money is required to start business, to keep the business going, and the sole purpose of business is to generate wealth. In this context, we have to understand that money is got multiple uses as well, and this money is something that cannot be procured by a low cost. Money comes at a cost and we have to pay certain amount of money in order to obtain this source of finance. Third and most importantly, money is a scarce commodity and you will see that we have to really do something about using the money that we have efficiently and see that the needs are met. In this context, we understand that finance has multiple uses. Secondly, it is not available for free and it is a scarce commodity. In this outset, we find the significance of finance and therefore the subject of financial management becomes very important. So you will see that when finance is used properly, you will see that the cost of finance becomes less. And secondly, you will see that you are able to effectively use the resource that is made available to you. And thirdly, effectively managing financial management enhances the efficiency of the organization and therefore productivity and profitability of the enterprise increases. So what is financial management? So understanding the significance of finance, we can define financial management as all those activities which are involved in procuring finance, effectively utilizing all the money that is available to all the required units in the organization and see that over a period of time sufficient surplus finance is generated within the company. So all the financial activities which undergo the management of funds in the organization would be termed as financial management. Now you will see the origin of financial management dates with a concept called as corporate finance, which means corporate finance was something that was dealing with management of funds for the organization. Earlier, the subject of financial management was largely referred to as corporate finance, where you will see that the main activity of corporate finance was largely dependent on the activity of sourcing finances for the organization. So, the major activity of corporate finance was centering around procurement of finance for the development, expansion and running of the enterprises. So, you will see that corporate financial activities were largely centered around episodic events like procurement of funds, mergers and acquisitions, strategic management activities. But you find that there was a lacunae in the concept of corporate finance, which means that corporate finance was largely thinking about procurement of resources, whereas the idea of managing finance within the organization were largely not taken into consideration. Hence, the evolution of a subject of financial management came into existence in order to satisfy the lacunae of corporate finance. So, you will see that financial management as a subject per se not only refers to the procurement of funds from external sources and facilitate it to the organization, but it also is concerned about all the activities which are involved in maintaining and allocating financial resources within the competing ends of the organization and do so in such a way that funds are efficiently managed and the cost of finance to the organization are kept at a minimum level. Now, is financial management a subject which is in isolation or whether it is related to other disciplines? Financial management is not a subject in isolation and it is related to various other management disciplines. We will see the relationship between finance and other related discipline in the forthcoming slides. finance and economics. Finance and the subject of economics is largely related. So what is economics? Economics is a study of allocation of scarce resources among competing ends. So we all know that finance as a resource is a very scarce commodity, and therefore principles of economics will definitely go into managing finance in an organization effectively. So generally the study of economics is divided broadly into two areas, microfinance and macrofinance. So when you look at the subject of macroeconomics, you will find that macroeconomics as a subject deals with the influence of macroeconomic factors on the general economy as a whole. So when we look at macroeconomic factors, factors like government policies, monetary policies, fiscal policies, inflation, and so many other factors have a large influence on the economy. And institutions like business institutions are not operating in isolation, and you will find that these business entities are largely affected by economic factors. So understanding macroeconomic principles and concepts and its influence on the business units will largely help you to manage the finance of an organization. Therefore, the subject of financial management largely draws from the macroeconomic concepts. So if you look at the concept of microeconomics, it largely depends on the theory of the firm. So the functioning and the cost and revenue principles of the firm is largely influenced by financial activities. So understanding the principles of microeconomic factors will also be a significant part in understanding financial management activities. So we can see that finance as a discipline largely draws from macroeconomics and microeconomics principle. Secondly, we can see the relationship between finance and accounting. So accounting in principle talks about systematic recording and tabulation of accounting information, and this helps us to keep track of all the financial activities that are happening in the organization. So accounting as a function deals with systematic recording of data, and this systematic recording of data becomes the input for all the financial activities. So when financial management deals with various activities and decision making situations based on accounting data, we can really say that accounting plays a large role in understanding financial management. Apart from economics and accounting, finance as a subject is related with various areas of an organization like the marketing function, production function, and you will see that in order to make effective decision, finance heavily draws from subjects like quantitative methods. Now we will move on to the scope of financial management. The scope of financial management could be understood by two different approaches, the traditional approach and the modern approach. The traditional approach primarily concerns itself with the procurement of funds from the investors into the organization. So when we say procurement of funds, it involves all the activities of raising funds from probable investors and bringing it into the company. All the activities concerned with procurement of funds were given lot of importance, and you will see that this particular traditional approach did not focus on how money could be effectively used within the organization. This external centric approach was a serious limitation to the traditional approach, and therefore the traditional approach was converted into the modern approach. So the modern approach started providing a conceptual and analytical approach to business decision making. When I mean conceptual and analytical approach to business decision making, we mean that this particular financial management as a subject or a domain not only concentrated on eccentric approach to financial management, but also started concentrating on internal centric approach to financial management. When I mean internal centric approach, it not only deals with procuring funds from the external resources, but it also involved activities such as how this particular resource is effectively used in the organization for generation of profit and wealth to the shareholder. Next, we will move on to functions of financial management. The functions of financial management could be classified into three different important domains. The investment decision. The investment decision is concerned with how money could be procured for the various expansion, development and startup of enterprises. The investment decision refers to long-term deployment of resources in the organization and also tries to identify the requirement of short-term resources for the day-to-day functioning of the organization. So, investment decision is largely divided into capital budgeting decision and working capital decision. Capital budgeting decisions are called as long-term investment decisions. These capital budgeting decisions generally refers to the idea of trying to find out which are those profitable projects which can be chosen by the organization, whereby investments can be made which will always stand by the objective of the enterprises. On the other hand, short-term investment decisions, which is also referred to as a working capital decision, refers to the creation and usefulness and procurement of short-term sources of capital which will be very useful for the day-to-day functioning of organization. Next, the second important function of financial management refers to the financing decision. The financing decision is falling under the category of trying to identify what are the different sources of finance that are available to the organization. When I say different sources of finance, we also have to understand that different sources of finance have different costs. Now, an organization does not survive by using one single sources of finance. When it is using multiple sources of finance at different costs, it is important for a financial manager to understand what is the total weighted average cost of all the capital that have been employed by the organization. So, this concept of cost of capital will help us to understand what is the cost at which we are using the funds in the organization. The financing decision also involves in understanding what is the proportion in which we have to use the different sources of finance that are available to us so that the cost of financing is at our minimum. It also tries to explore how the different sources of capital could be leveraged in order to attain maximum efficiency of resources in the organization. Lastly, dividend decision, which is also referred to as the residual decision. See, investment is being made in business in anticipation of increasing the value of the enterprise and increasing and maximizing the wealth of the shareholders, which means this particular business enterprise should be capable of generating profits which could be distributed to all the investors who have contributed to the business to be run. In this case, dividend decision, which is also a residual decision, talks about how the excess money that is being earned by the business, whether it has to be distributed or it has to be kept back with the organization. So, the dividend decision will talk about how much of money the company has to keep with itself as retained earnings and how much of money has to be distributed to the shareholders in order to keep them happy. Coming to the objectives of financial management. Traditionally, the objective of financial management was profit maximization. Now, what is profit? In simple parlance, profit refers to the difference between the selling price and the cost price. So, in business, selling price will be the price at which the sale has been initiated, and cost price refers to the cost we have incurred in order to make the production. The difference is the profit. And the aim of any business enterprise generally was to maximize this profit to a greater extent. And no wonder profit maximization was the objective of financial management for quite some time. But the concept of profit maximization could not stand the test of time because of the vagueness that surrounded the concept of profit. So, when I refer to the term profit, am I referring to it as net profit or gross profit? I am talking about profit before tax or profit after tax. And am I trying to give some influence for inflation in this particular profit? What profit is acceptable to me might not be acceptable to other investors. So, when I say the term profit, I could definitely not be talking about some terminology which is accepted by the entire investing community. So, because of this serious lacunae, profit maximization could not be the objective of financial management in the long run. Hence, the concept of profit maximization got converted into the concept of wealth maximization. Now, what is wealth? Wealth is steady increase in the value of any resource over a period of time. So, instead of simply not trying to maximize the value of money, if the idea of all the activities in the organization was aiming at increasing the value, or in other words, the wealth of the enterprise, then that could be a reasonably a good objective. Therefore, the objective of financial management is wealth maximization, where all activities and decision making that are done by financial managers are generally aimed at wealth maximization rather than trying to simply maximize profits. So generally, the organization of financial functions is like you have a board of directors at the head. Under the board of directors, there will be a managing director who is appointed, and under the managing director, in order to take care of all the activities of finance, a vice president finance is there. And under the vice president finance, so you will see various other activities of the financial management, accounting, treasury, financial management and control will be there, and all the financial management activities are structurally carried out. So if you go by the basic concepts of finance, you will see that we have to understand that finance as a resource is very scarce, and therefore whenever we deploy funds today, we are anticipating returns in the future. So in this context, we spend today, invest today, and we throw money today in anticipation that lot of returns will be generated at a future date. So in this context, we have to understand the concept of time value of money. The concept of time value of money goes like this. Money has time value, which means that money that is received today has more value than the money that is likely to receive in future. Now, why there is a difference in the value of money that is received today and tomorrow? When you have money today, you will see that this money is certain, and this money could be used profitability either for consumption, savings or investment. And when savings and investments are done today, in future it is capable of increasing because of the resulting return that you will get on the investment, and therefore the value of money will increase in future. But if the same amount of money is received in future in the same denomination, you will see that you have foregone the investment opportunity that was available in front of you. So here the caption, bird in the hand is worth two in the bush holds good, which means it is always better to hold certain money than to sit and worry about money that will be available in future. So in this context, you have to understand that money has value which is in present and in future. Why money that is available in future is not of significance is because of two reasons. One, the uncertainty that is revolving around the money that you will receive in future, and second, the lost business opportunity or the investment opportunity that you get because of the arrival of money at a future point of time. So in understanding the time value of money, you will see that you have to understand the concept of compounding and discounting. Now, what is this principle of compounding? Compounding is a simple principle where when you invest an amount, say P, in a bank at an interest rate of R for a period of 1 year, the money will get compounded into principal into 1 plus R the whole power 1, which means a rupee of rupees 1000 invested at 10% will yield a return of 1100 rupees 1 year from now. Similarly, if this 1000 rupees what you receive today is received 1 year from now, you will see that you will receive the same amount of money which if you had received in today's date, you could have invested at 10% and earned a return of 1100 rupees. So this says that the principle of compounding, whereby money when invested properly at a particular rate of return, you will see that grows in value, and the principle of compounding could be explained by the formula P into 1 plus R the whole power n. And in the concept of discounting, if you see that instead of receiving this 1000 rupees today, if you are going to receive this 1000 rupees 1 year from now, you will see that, and if you had an opportunity of investing at 10% rate of return, you have a lost opportunity of not being able to get a return of 10%, which means your opportunity cost of capital is 10%, whereby you will see that the 1000 rupees which you receive on a future date has to be discounted by 10%, where P, that is 1000 rupees, will be discounted at 1 plus 10%, and you will see that the value of money is discounted by, and you will see that the 1000 rupees what you receive is lesser in value than what you actually will be receiving. So in this context, you have to understand that the money that you receive today is more in value, and the money that you receive in future has to be discounted and therefore will be less in value. Now, this is very important in the context of financial management because in a business enterprise, you set aside money today in anticipation of getting returns in future, which means that all the future cash flows of the firm has to be discounted and brought to present value terms, and only that money has to be compared with the money that is outlaid in today's context. This will help you to understand that you are not considering whatever money you get now and whatever money you are likely to receive 10 years from now in the equal parallels. So the concept of time value of money is very, very helpful in taking reasonably good financial decision. In understanding the concept of finance, you will have to understand the concept of risk and return. You make an investment either in a business or in any other kind of financial instrument in anticipation of returns. So return is that premium which you are being given by the authorities for foregoing your liquidity or for partaking your money as a capital instrument for other business opportunities. So these returns sometimes are fixed and sometimes variable. And when you are trying to quantify the variability in returns, that accounts for the difference or variability in returns, and that when quantified is constituted as risk. So risk is nothing but variability of returns. And in this uncertain world, you will see that there are certain instruments where you are not able to accurately predict the returns that you will receive in future. And you will see that whenever you take huge risk, you are capable of earning huge return. Understanding and quantification of risk and the relationship between risk and return is very important because higher the risk, higher the return, lower the risk, lower the return that you get. So in this particular lecture of fundamentals of financial management, we understood the concept of finance and how finance is a significant resource for an organization. We saw the scope and the objectives and functions of financial management. We also saw the relationship between finance and other related disciplines and also tried to understand the basic concepts of finance. Thank you.